Good evening, good afternoon again to all of you. We are going to get started with this last session of the conference before the recap that Marco and Jordi will do after we finish. The first thing that I would like to do is to excuse our third panelist. It's a pity, but Herman Dimes cannot be with us today, not even online. Unexpectedly, for personal reasons. We were told about that 3 days ago. There's no way he could join us. It is a pity because for sure it would have contributed to the discussion. Now, in any case, we have a brilliant panel. We have with us Sophie Helias, or Helias, I don't know if I pronounce it well, Sophie Helias. She is the president of LeaderXXchange, right? She has a brilliant background in the investment world, in activist funds in the past, and she is involved in several boards, as I understand, and promoting good governance all across the world. We also have with us Juvencio Maeztu. I had already the privilege to discuss with you last year, I remember. He is the deputy CEO and CFO of the well-known Ikea group, okay? Now, this afternoon, we've been discussing about the challenge of corporate governance and sustainability and what the role of the board could be in surmounting that challenge. Now, I'm supposed to be moderating this panel, which means, in my understanding of things, that I should be provoking the two guests here to have a lively debate. And I plan to do that. I plan to start a bit on the provocative side, a bit tying also with the presentation of the previous panel, where Jay Barney, in a way, told us that it was possible to achieve goals of sustainability and at the same time to have a credible, sustainable strategy. And I would like to start asking you both whether that's the case always. I mean, is it always the case that we are in a business where we can create value and at the same time satisfy all the stakeholders and the requirements, the increasing requirements of ESG that our society is placing on us? Or is it the case that this can be done in some specific fields, for example, as in hydroelectric, which is very much closely connected to the energy industry, and therefore it has a clear room to maneuver to add value consistent with its own strategic positioning? Or do we have a situation in many businesses where actually undertaking ESG objectives is costly? At lunch today, we discussed the matter because one of the CEOs sharing the lunch argued that it was difficult for them to undertake ESG because the leading competitor in their industry was not doing that. And therefore, if they were undertaking ESG goals, they would be losing market share. It seemed to me, that particular case, that shows that there are many businesses where that is not easy to make compatible. So I would like to start by that question, which in a way goes to the heart of the matter. Maybe Sophie, you want to start?
So thank you. First of all, I want to really congratulate the conference because it's been incredibly challenging to, in terms intellectually, just to combine the academic and the business, and building that bridge between academia and business, I found has been incredibly insightful. So thank you, and I look forward to a robust conversation. I think the things what I've taken away from the discussions earlier today and the discussions in the past, and also the experience, is really framing this as sustainable business models as opposed to ESG strategy or not ESG strategy. I don't see ESG as a strategy. I see that we have to have a sustainable business model. And the sustainable business model is value creation for your shareholders and stakeholders, depending on the environment that you're in. And to the extent that you have a sustainable business model, you naturally have to have ESG drivers. You have to have social factors that you integrate. You have to have governance factors that you integrate. You have to have environmental factors that you integrate. You cannot operate today in pretty much any environment without looking at some of these environmental and social factors. So the idea that ESG is something that you would rather not do versus would rather do, I would rephrase that and say, do you have a sustainable business model? And that's the way investors are looking at it. They're looking not just for the long term, but whether this company will survive the competitive challenges. So that's really how I would see that. In that respect, then you go back to some of the earlier conversations today with some of the academics, was really thinking about who's your base. So depending on whether you're a client base or your investor base or your broader stakeholder base or your regulatory base, it's going to create an environment where the option of integrating ESG is really not an option. And I would argue that for companies that want to have a sustainable business model, that really are looking to the future for growth, not integrating ESG into their strategy and not thinking about their business as how it will grow in the future is a competitive, strategic challenge for them.
Okay, Juven, what is your view? What is your take on this?
No, I think it's this is about dilemmas, and it's about when you have a dilemma, it's not one or the other; it's a both an approach. Because I agree that you cannot satisfy all the stakeholders, but you have to find the merging point of all these topics. And for me, we are at the beginning of the most important decade of the humankind, and it's about taking action. I think we have been talking about the why and the what over the last years. And I don't know anyone who wants to destroy the planet, but I know many people who are lost, and they are lost in the dilemmas. And it's these dilemmas that are making a more difficult thing. I want to mention 4 dilemmas that we face, and then we try to find a way forward. Some people say, yeah, sustainability is a problem for the bottom line of the company. I truly believe that it's good business to be good business, and it cannot be charity. Sustainability has to be business. Mm-hmm. If it is not business, it will never take off. If I take 3 examples, in our case, for example, we get more returns from the investment in renewable then we invest 6.5 billion right now. We get more than the return we get from the German bonds. Our products that are in the forefront of sustainability are selling 30% more than comparable products. And then the best energy that you don't use, the best energy is the one that you don't use. So I truly believe that being smart in climate is being smart in resources. And being smart in resources is the new low-cost model. So I truly believe that it's a low-cost model. A second dilemma here is that sustainability is for the expert. It's very complex. It is true it's complex. I'm spending a lot of my own time in understanding the dependencies. But at the same time, it's the business leader who has to find the solution with the support of the expert. Expert cannot drive the sustainability agenda. Business leader has to drive that. Third dilemma is that sustainability is a luxury for the few. Only the ones who have money has to pay for that. It can never be like that. I truly believe that it has to be affordable. If it is not affordable for the many, it will never take off. If I take an example, 4 years ago, we faced a dilemma. The incandescent bulbs that we sell. It was a very good top seller, and it was not good for the planet. And the LED bulb was costing 10 euros. And then we decided to go full-in, and then we went full-in with the LED bulbs. And we phased out a top seller. Today, LED is €1 because volume is the enabler and it's the new top seller. So at the end, then the last dilemma is that the solution for the sustainability is to stop consumption. To stop consumption. I don't believe it's that. We have to stop the bad consumption. And the bad consumption comes when you have bad production. And you destroy the planet when you produce, and then it's the unreasonable consumption. Because if you produce in a way that you look after the planet, then consumption is good, because you create employment and you pay taxes. So I think it's important to face dilemmas, because this is where the discussion is, and it's about helping people to find the how, not too much the why and the what.
Now, so I started asking you whether making compatible sustainability with profitability was actually possible in all lines of business. And I told you that I don't think that's the case. Both of you said that there are no trade-offs, that it can be done. Now, haven't we seen cases of remarkable examples of companies that have sustainability goals where those goals have been thwarted by the action of capital markets and short-term approaches? Think for a second of the case of Danone, the well-known French company. They went to the length of even changing the legal nature of the company, which could be also an obstacle for the broader goal of sustainability. They became the Entreprise à Mission. And a few months later, Emmanuel Faber, the chairman and CEO, who was the big promoter of this stakeholder approach in Danone, is gone. Is it really possible when you are in the public markets and you have the daily stock quote to run a strategy that maybe satisfies barely the stakeholders? It may earn a return which is higher than the cost of equity, and therefore, in the language of Jay Burney, it's satisfying the stakeholders barely, sufficiently, but it's losing against the competitors. Do you really think it's possible?
So I'm happy to.
Yes.
Yes, I do, and I think this is what you pointed out too, is that sustainability doesn't replace performance. I mean, it's a business. You're running a business, and the issues that were related, from what I read in the papers, with regard to Danone and with other companies, the business was not performing well, and it was not performing well against peers in a very low margin business. So the idea that it was sustainability that resulted in poor margins or poor performance, it could be that the business strategy and its execution resulted in poor performance. And I would actually argue a counter case with Unilever. When Unilever was the target of activists, as Danone was, Unilever's ESG became a defense against the activists, because the activists wanted to merge two companies. One company that was a major cost cutter, that had very different social values, very different employee engagement, and the other company is renowned for its social values, its employee engagement, and its commitment to sustainable goals. And that poison pill, I would call it the first ESG poison pill I've ever seen, or sustainability poison pill, but I would say it's actually a cultural poison pill, prevented this activist from going through. And so, again, I really believe that, and it's what I see in all companies I'm involved with, whether on the board or advising them. It's what I see with investors looking at it. Investors that in the past didn't even consider ESG, and we heard that with some of the speakers earlier, and business CEOs who engage with these investors, are incorporating ESG in their parameters and their investment decision-making process, either to select companies, to exclude companies, to engage companies to change, and to have impact. So we're in a really different universe today, and companies that say that sustainability is really a nice to have and we can't afford it are not probably seeing it as a strategic to their business as it is. It's not just about cost cutting. It's not just about changing certain products. It's really about rethinking their business, rethinking their engagement, and developing innovative strategies and perhaps innovative business models to drive growth.
Okay, Juven?
Yeah, from our side, I think it's important to define what does performance look like. Because I think if we don't integrate sustainability inside the business, it will be always considered as a charity and an enemy of the bottom line of the organization. In our case, it took some time in Ingka to find an answer to that question, because we had a big purpose to create a better life for the many people. But then you find inconsistency in the decision-making. And every single decision you take in company has to live up to the purpose. And then we clarified performance. So we said, okay, now, and we did a year ago, performance is about 4 things. First is about creating better homes for consumers. Not only selling products, better homes. And this is when you talk about healthy and sustainable living. This is about sharing knowledge and helping people to have a more sustainable life. Then the second one, it's about a better life for people. And it's your own employees, but it's employees in the supply chain, but it's the communities you touch. Then the third one is a better planet for all. So this time, now every country CEO and organization also has a target on CO2. So maybe last year it was 300,000 tons. This year has to be 270,000 tons in your country. And the fourth one, it's about better company for the long term. And better company for the long term is about making profit. Because by making profit, you keep adding value to the other 3 dimensions. So it's not one or the other. It's impossible to be a sustainable company if you don't have a long-term performance, because then the company is gone. So profit is a friend, not an enemy. In our case, I am grateful to work in a company that is owned by a foundation. So there is no single dividend that goes to the private pocket of any shareholder. So I recognize this is an additional advantage, and everything goes back to society, everything. Yeah? But it can be also in a public company, because you have to deliver good performance, otherwise you will not exist. I think that built a bit of peace in our own narrative, because we are demanding leaders to be high performers, regardless of our ownership. We need to have resources. And then you find a value to, for example, cost performance programs. We are famous not only by the low price, but also by the cost consciousness, and it's a very tough agenda in cost consciousness. But you know that the purpose of reducing costs is actually to keep adding value to the other 3. So the more we are clear on what good performance looks like, the better, both internally and externally. And externally is even more relevant.
Okay, I think that your answer, thanks, those are wonderful comments, and they lead me to another question, which complements the previous one before we move on. I like your comment about the foundation, because certainly it's nice to have profit as a friend or not an enemy. Sometimes I like to say profit as a means, not an end, right? Because the ends are the other goals in your purpose. But that's easy to have when you have a foundation. In capital markets, there's a question mark. And related to measurement of performance, what do you think of how we are going to measure ESG performance. How about the metrics to be used? Because when we're talking about the bottom line, we all know what it is. I mean, well, not everybody knows, but essentially the right measurement is the return on equity compared to the cost of capital, the cost of equity, on a sustainable basis or for several periods. How about ESG? How do you know that Unilever was doing better than Danone on ESG? We know that on returns, on financial returns, it was doing poorly compared to Unilever. But how about the other dimensions? What is your view on this wall of the metrics that are being developed?
So I think that's a really good question. And I think we had this conversation earlier because there's really no standard metric, even though there's certain frameworks that are, clearly emerging. I think one thing I just wanted to just add to his point earlier, which is really common to all companies, is the importance of sustainability for employees. And that employees, whether they're young coming in, but the talent for competition for talent is so large today, particularly for certain categories, and that sustainability is really a driver, both in being attractive and attracted to the company, staying with the company, and also performing for the company. So I think that's something that is really common, and that companies that ignore that are going to be less attractive and will not be attracting the best talent. So I think that's something just to step back on. On the metrics, first, I don't believe that obviously there are certain standards when it comes to climate, environmental metrics and all of that. But really going back to your earlier comment, if you go and start with the purpose, and then you develop your strategy, and you develop what is really significant, it could be material, that's one. I would also add meaningful, which might not be material, but just as meaningful to your purpose. Then you can start developing the identifications or the areas of your different metrics. But before you get to the metrics, and you need to have a system in place, because ESG is really transversal, but a governance system in place to collect the information, to make that information and that data, to verify that information, to make it consistent, and to make it meaningful. Because one of the things that I've seen, and I think it's a challenge for all companies, is what is the relevant metric? If you have too many metrics, is that relevant or not? And two, how do you disclose that, and do you disclose it? And not all companies have that expertise internally. So my suggestion has always been to develop a governance framework that would really allow a certain reporting system to the leadership of the company and to the board, and then to look at the different metrics that are directly tied to the performance of the company in terms of extra financial factors. And then the other indicators show you whether you're on track or not. And I think the CEO of Schneider was really very clear in terms of how they built that from a regional basis. But my experience has been that to have it very effective, it needs to be transversal. It needs to be interdisciplinary. And the board needs to be interdisciplinary as well. It can't be just a single committee. It's going to also be in compensation. It'll probably be also in, most certainly in audit, probably in governance, and then at the full board. That's how you determine those metrics, and then you try and test, and you talk to your stakeholders, because you got to make sure that whatever metrics you use really match some of the critical points that your stakeholders mentioned to you and raised with you, so that you have no gaps.
Okay, Juvencio, how do you see
I think, Jordi, your question goes to the core of the topic. My biggest takeaway in the last 2 years, it's the importance not only having an awareness of this topic, but to have a deep knowledge as a leader. I cannot be a good leader if I don't have a deep knowledge on that. Boards and CEOs, of course, they need to know about cash flow. They need to know about financial forecasting, but it's a must that boards and CEOs have a deep understanding of the climate model, or ESG, not only climate, but also on the metrics. If I take 2 or 3 comments on that, but this is paramount, your question. It's about, we are lucky that we work with the world-best institution in the world in order to set up the metrics, because some of the metrics are clear, some of them are under construction. For example, CO2 absorption, CO2 storage. So there is a lot of things that are under construction right now. But you need to have a deep understanding how it is working in scope 1, scope 2, and scope 3. And scope 3 is the challenge, and it's the most difficult one, and it's the most important. At the end of the day, we need to answer the following question. If my company disappears today, will this world be better or worse? Because my company is not. And this is the way you have to measure. And then, of course, climate. Climate is complex, but I think we are working, many companies and institutions, on that. But it's not only about building metrics, it's about having also carbon forecasting, not only financial forecasting. You need to know what is going to be your carbon footprint in the next 2-3 years. We have set a commitment that by 2030, not 2050, by 2030, we are going to be climate positive by removing more CO2 than the Ikea value chain emits. And then we have deep breakdown in everything, from the customer travels, to the raw material, to transport, to our own energy operations, to the renewable and recycling. And we are following up all the actions and having forecasting. Do we have all the answer? No. Half of the things we have the answer. The other half, we are finding the way to have that forward. And that goes for the climate. But also we talk over the lunchtime. It's not only sustainability, it's not only climate, it's also about social. And this is a more foggy environment. You can have some more clear metrics, like the gender equality or inclusion of the less privileged people, or the pay gap in between women and men. So you can have some easier metrics. But there are many other areas that either you have to measure in a more qualitative way, not only quantitative way, but you have to anyhow follow up. So the core is metrics, and it's about forecasting. And then how can we build standards that are good for many companies, but also standards that are specific for your own ones. And the important thing is being transparent, because nobody will accuse you because you are not perfect. Nobody. My family is not perfect, your family is not perfect. But people will attack you if you don't show progress, if you don't close the gap. So I think it's not a risk to talk. I think actually silence can be the biggest risk. You have to talk about the half-empty glass, but also the half-full glass, and you have to close the gap in the half-empty. So metrics to talk about the half-full and half-empty builds a lot of trust and credibility in society.
Thank you, Hu, and thank you, Sophie. One of the things that you've said, Sophie, is that the metrics for ESG are idiosyncratic to each company, to the conditions in a way.
I mean, there's some core, right? There's some core, but
it has to be adapted to each
has to be adapted because each company is really different.
And on the other hand, it's important, we all know in the world of business, we are compared to our competitors, and investors compare to the rest of the world, your own particular company and how you're doing in several dimensions. So there is, I fear, and I shared with this with you when we were preparing this session, I fear the development of a single standard in the industry, right? I mean, this has happened in governance, and when a single standard develops, it kills certain business models which do not adapt to that, which do not work well with that standard. We've seen that in governance. It may not happen in carbon, because carbon is something that you can really measure well. But when you go beyond carbon, especially if you go to social, I mean, what do you think will be the evolution of the, I mean, this whole ecosystem of consultants, of rating agencies, of investment banks providing ratings, where we will end up on this?
Well, I mean, I don't know where we're going to end up, but clearly, if I had crystal ball, but clearly what I think we're all seeing, but we've seen also with today and also with some of the surveys, I think the Edelman Trust Survey came out recently on the trust parameter of companies, and trust in companies has never been higher. Whereas in the past, it was trust in government. And there's a reason for that, is that, as many have said, and the academic studies show, is that there has been certain failures in government, and COVID crisis showed that. Companies stepped up during COVID. And they stepped up for the safety of their employees. They stepped up, as many of the CEOs mentioned during the conversations today and yesterday, with a number of board meetings, outreach with their employees, constantly talking to their suppliers, talking to their customers, and in a period of crisis that none of them had ever experienced in the past. So, you know, really what I think on the social side in particular is I think what COVID has done, and I've seen that with the investor focus, and following up on what you said just earlier, is that they're asking companies to open up and talk about social. So it's not just about the standards. So you can have certain standards. For example, a number of companies will not talk about their employee turnover rate, and because they say it's not really relevant. They might have a global turnover rate, but certain companies are in retail sectors where there's a very high turnover at the front line, and maybe they'll just show the turnover at the C-suite level. So turnover rate is one. There might be not that much disclosure when it comes to certain whistleblowing complaints, things like that. Those are indicators of corporate culture, and those indicators of corporate culture as an investor are a risk or an opportunity. And so what I see going forward, because I think it's very messy, what I see going forward is probably a core common standard of certain metrics, but companies disclosing more and more on these topics, because that information is going to get out. No matter what, it's going to get out. Employees are going to go on LinkedIn, go in Glassdoor, talk about what's going on in the company. You're going to have whistleblowers that are going to come out. We just saw with Facebook today or yesterday, actually. So you have to really integrate these social indicators and show these and share these social indicators when you believe that they're strong in terms of the content and the validity of those indicators, so that you can communicate to your investors and the financial community your corporate culture. I think you don't have it just with numbers. And these elements, social and governance, define a corporate culture and give investors information that they would not have just with a financial statement.
Good. Ruben?
Yeah, I want to build what Sophie said. And answering your question, Jordi, I agree with you. I agree that we cannot be, the destiny of our company cannot be on the hands of very dry standards that everybody follows. I think the best standard is to be clear on your values and stay true to your values. You mentioned, Sophie, the trust barometer, Edelman, I believe, is that, no? I think it was business that came with a 61%. So people have more trust in businesses than in the other three institutions, which is government, NGOs, and media. So people are expecting businesses to close the gap that governments are not closing today. And because they are expecting you as a business to be more vocal in social topics, the many questions that I get is, can you end up in trouble? Because you are going to take a space that you're not supposed to take, but people, society are demanding you to take that space. If I say this, or if I support these individual rights, can I end up in problems here, or with the law here, or with the country here? Can geopolitics affect my business? And then you can end up in a lost space. That's what I think the comfort zone for me and for us is to go to our values. What do I believe? I believe that leadership is personal. I cannot be a good CEO, a good leader, if it's not a personal thing. So, and the more you stay true to our values, the better, and the more you are clear to that. And I think this is a comfort zone, and this is there is a lot of complexity, but this is the comfort zone for us to take decision. Then is you are a standard. It's not a dry standard. I agree that some metrics, climate-related or basics in human rights can be clear and has to be black or white. But the other things is your belief as a human being what matters the most.
Okay, it's interesting the Edelman Trust results that you're mentioning. I believe that Professor Barney will believe that in the US maybe the company should be doing it because the government is not doing it. In Europe, at least in continental Europe, there's this trend that precisely COVID crisis has increased the role of government in our societies. So it's an interesting debate going forward. Before I turn to the audience for more questions, in your answers to the previous ones, you have already built a bit the argument as to how do you incorporate ESG into your competitive strategy. I'm not sure I'm convinced, by the way, if I use the stakeholder model of Professor Barney or the resource-based model. I'm not sure that all companies can do it, but you've given some indication of how to proceed. The risk is that some companies do simply greenwashing. They do simply tick the box and they go away with it. They get away with it. Now, on top of the building the competitive strategy, what should be the role of the board? How should the board behave? Should it leave it to the initiative of the managers? Should the board take the commanding role on this issue? What do you think? Maybe this time we can start with Juven.
I like what René said in the couple of sessions ago about leading in pandemics and the role of the board. I remember in the very peak time of COVID, it was spring 2020, at some point, for some time, more than 75% of Ikea stores in the world were closed in all the countries where we operate. And then you face the business, what do we do here? And we didn't have a map to navigate. So we had to take decisions based on our values and our moral compass. And it was, our board is a supervisory board. So because it's the management board in our system, the ultimate decision-making of the company. But of course, we use this as a sounding board. And it was the easiest way, the easiest time in this complexity to talk conversation, to take decision, because there was high level of trust, high level of freedom, but also high level of connection in the very basic needs of the human being, because it's a crisis. And we found the same with our leaders. This is a time where the company was led by itself. Both Jesper and myself, who are in the board of the company, said the company is moving by itself. So what is the role? I think the role is to be clear on the deep values. And I think the role is not only, I agree that the board has to create awareness, has to choose the right people, has to nominate the right leaders, but I also believe it's the role of the CEO of the company to challenge the board. I also believe it's the role of every leader in the company to challenge the CEO of the company. So I think more and more we go to an environment where everybody has to be more demanding. Otherwise, you can end up that you don't attract the right people as a company. So for me, the role is to really have a deep discussion on the values. And then the how, management has to find the how. I am not expecting an advisory board to tell me how we should lead the company, but I am expecting the supervisory board to challenge me with the question, is this enough? Is this the maximum you can do? I am expecting the board to ask me, what does it take? I am expecting the board to say, to really put the tough question on the table. And this is when the discussion has to happen. And then, of course, it's about building an organization that the culture and the values is reflecting the decision you make. Because the worst thing can happen is that there is a double morale or a double language. This is when you lose trust in your board, and this is when you lose trust in your own people. So I think not to have a double language is paramount.
Yeah, walk the talk, right?
Yeah.
Sophie.
I think that you're spot on. And I would perhaps add that it really depends on the maturity level of the company when it comes to sustainability. Different companies have different maturities. And companies that don't have the maturity on ESG probably don't have the expertise, both within the organization, but also on the board. So that's the first thing. And the second, I think the whole point of the values of the commitment of the company, which really from which you draw your strategy, build your strategy, I think the board systematically needs to bring back the decisions that are being offered and the decisions that have to be made against that strategy. And then where I think the board can challenge management the most is to really think about their stakeholders perhaps in ways that they haven't, because if you have a board that's very diverse, they will have experiences from these stakeholders and engagements in other entities, and just suggest, have you thought of this? And then finally, I think to me, the critical thing is, and I keep going back to process, beyond you have to have the right people, but do you have the right process in place so that you have that information coming up and with that kind of reporting structure? I think your point on knowledge is the most important point. If your board doesn't have the knowledge, if your management doesn't have the knowledge, you can ask all the questions you want, you just won't understand the answers. So I think that's really a critical point.
Thank you very much. I think that we already have questions from the audience, please. Yeah, now I think, no.
Okay.
Yeah.
Oh, no. Nice working. Good afternoon. Thank you very much for this such an inspiring session. Look, I guess because you talk a little bit about Unilever, and I work for Unilever, I wanted to make just a couple of comments, very much in line with what you said, Sophie. And it's about people and metrics. I think you are absolutely right that what makes the difference in Unilever for us is that people who want to join Unilever truly believe that sustainability is a fundamental part of what makes them really happy to come to work to Unilever. And I think that's one of probably the biggest difference to other places, where we truly believe that it's not just the P&L, it's just what is the impact that we're going to have. The second thing is the metrics. We talk about the metrics, and the reality is that, as we all know, we only get what we measure. As you look at the metrics of Unilever, in fact, it's super detailed. Depends on what business are you in. You are selling, let's say, carrots, and you are using carrots, you will measure what is the percentage of tons of carrots that are sustainable. If you are using sugar, you will do exactly that same thing. And that's very personal, because it's your business. It's not the business of the company, it's your business as it is. And then I have a question. For Unilever, we said that our purpose is to make sustainable living commonplace. And I was wondering, what can we do? I mean, looking at Ikea, which is such a leading company in this aspect, and I'm really thank you so much as a consumer as well as what you're doing, is how can we make sustainable business common practice? How do we make sure that other companies around the world really push for this? At the end of the day, I often think that I don't want that our sustainability strategy is a competitive advantage. I really wish that it's not, because we are all doing the same thing. But I wonder, maybe from your positions, what can you share with us about how can we accelerate that, making sustainable business a common practice? Thank you.
Well, who takes the challenge?
Okay. Thank you for your question, and happy to hear you work in Unilever. I feel great respect and admiration for that company. What we can do, I think we have to. No, it's not what we can, it's what we have to. And I would summarize in 3 things. The first one, we have to walk the talk. We have to lead by example. Otherwise, you are not credible. And leading by example is to permanently closing the gap. And it's about communicating what you have done, what you are doing, and what you will do. And then keep moving on that basis. You have to walk the talk. The second one, it's about influencing others. I think we have a big responsibility to speak up. And we have the big responsibility to influence. Sometimes we don't do that enough, either because maybe if I am not perfect, how should I do this? Can I be accused of greenwashing? Can I be at that because I am still have to close my half-empty glass? I think we have to. We have to really inspire people and to do more. And the third one, which I believe we are not doing enough, is much more partnership. Sustainability is extremely complex. No one can do everything, but everyone must do something. And partnership is critical. And it's in partnership when you find probably the low-cost solution to the big problems. You cannot solve mobility by yourself. You cannot solve EV electrical setup in a city by yourself. You cannot solve development materials innovation by yourself. You need to do a lot of partnership. And I think big companies have a big role, not only to support, but also to really be more proactive in partnership. The startups are normally better than the big companies. So if we walk the talk, speak up, and also work together, I think this is a good way forward.
Sophie, you may want to add?
Yep, so I have 3. One is open source. I know one of the companies on whose board I serve, we did our sustainability report with open sourcing at Caring. We did the whole integrated report with open sourcing so that other companies could use that. So that really sharing the knowledge, improving the metrics, and understanding that it's a work in progress. And I think that's something that's really important. Large organizations have the resources to do that, and that's in what I would call an easy contribution to society. The second is invest. So I have one specific example, but companies, again, that have the resources and have the economic leverage, really the economic leverage to buy volumes. So I'm thinking about, in the case of Caring, where I serve, gold, sustainable gold. So gold is a product that the company buys. The company wanted to buy sustainable gold. It was very high priced. We're a big buyer. And what happened by buying more and more of that gold, sustainable gold, we got the prices to come down. And so now it's a sustainable business for other companies to buy sustainable gold as well. So I think going back to your carrots, if you're the biggest buyer of carrots, maybe there's an initiative that you can do to get it to be more sustainable in certain markets. And then the third is going back to the partnerships. And I think partnerships, we're seeing it, at least in the fashion industry, we're seeing companies coming together, coming up with the low-hanging fruit, clearly with certain objectives. The question is, it's like herding cats. So how do you get, competitors to work together? But at the end of the day, if they can get their costs lower, because that's really what it is, and at the same time be aligned with their purpose and have meaningful change, then that creates an incentive. So I think it's really those 3. And then finally, I know we had this session earlier, I have to really focus on innovation. Large companies have and continue to have little quasi-VC centers where they can support small startups that can innovate. And big companies can afford to do that, where the medium size cannot. And those little startups can come up with some really interesting solutions. I know we do that at Caring. We have little competitions, and then the brands get access to them. but they can come up with real solutions, whether in designing fabric, whether it's in recycling, whether it's in upcycling, in anything. Big companies have those resources, and these small startups have really good ideas. And out of 100 ideas, there might be 2 that are meaningful, and that's pretty good.
Thank you. We have another question?
Thank you for the talking. And my question is about, we have discussed at the beginning the relationship between sustainability and profitability, and it's possible to make a company profitable while being sustainable. No? My question is, till which extent this depends on an important society mindset change? And I mean that if you ask people if they want to be green and reduce the carbon footprint, everybody would say yes. No? When you talk about paying more for a sustainable product or reduce consumption, as you mentioned before, that it was key, then the answer probably is not so homogeneous. No? So I think in certain sectors it's going to be difficult to be profitable and while being sustainable till this is not happening.
Well, this is
That goes back to
one
your
of
point.
the fundamental questions. It was in my notes. How about the just transition?
Yeah.
It's very nice to be green, but it's very different thing to pay more for your gas, right? So what do you think of how should we, from the point of business advocacy, work to change the society's mindset? Sophie?
So I think, so I think the changing of society's mindset is really going back to consumer education when it comes to the choices that they make. And that's where companies that have products and services that have a meaningful impact, that are authentic, that are not greenwashing, that are not social washing, can actually have higher value. Where I really see changes behind the companies, or maybe above the companies, it's on the investment side. And the pressure that is being put on investors by their own clients and by regulators is really forcing them to look at their portfolio in a very different way. So whether it's in decarbonization, but also on social issues, and governance issues has always been a trigger, but social, environmental are much newer. These investors have to readjust their portfolios to meet those new expectations. And with investors pushing for that, because they're being pushed themselves, companies are going to be pushed for it, or they're going to be excluded from the investment pool of these companies. So I think on the corporate side, there's going to be, no matter what, there's going to be a transformation. And they're going to have products that are going to be more sustainable, or they're not going to get the right funding, or their cost of capital is just going to be a lot higher, in which case their products are going to be more expensive and less sustainable. So it's really a chicken and the egg kind of situation, but the pressure coming from investors is really not to be underestimated, because the investors themselves are getting a lot of pressure.
Could you want to answer? I have a few questions from the audience, and we have just 4 minutes left.
Yeah, go ahead.
So let me ask you, one of the persons that is following us online asks you both, and for a short answer, please, have you ever measured the part of profit which is caused by being sustainable in any of your companies?
I think you have to measure the profit that you will not get if you're not sustainable. We measure the profit we make by being sustainable. An example is if I take 2 or 3 examples, is the money you get for all the energy efficiency. You get money back. Or for example, we are famous by the meatball. You have we have developed this plant-based ball. It's 94% less footprint, and it's becoming the top seller now. So I prefer to measure the profit I make with sustainability. It gives you a lot of good energy to keep doing.
Yeah, there's a question on that we have already covered, the issue of metrics on governance. I think we have discussed. In fact, metrics on governance are more well advanced than metrics on environment and social. Also, we have covered another question that has to do with tailoring your ESG metrics to your company strategy, although that's a difficult issue. There's a question, Sophie, and I would like maybe to answer that, about the experience in developing economies where government policies on these issues are way behind. And what are the expectations there? A short answer, please.
So very interesting, and I think it goes back to some of the topic yesterday that Benk discussed on the platforms. So what we're in developing economies, impact investing is really quite significant. The issue in developing economies is really the collection of data. So on one of the funds I serve, we have sustainable goals and we also have impact investing. But really the data collection is the primary issue. And governments today are focusing increasingly on impact infrastructure as well. So I'm actually very optimistic for continents such as Africa, where you have a young generation of great innovators who have access to extraordinary platforms, great minds, and then you have an alignment with government public policy that is really focusing on impact. So yeah, I'm optimistic, but it's very challenging.
Okay, thank you, Sophie. Well, thanks to both of you, Ruben and Sophie, and to the organizers for giving us the opportunity to have this conversation. I think that we come out of it with a deeper knowledge of the problem and with a higher willingness to take it on and achieve our collective goals. Thank you very much, and an applause for our